My neighbor had this investment and they made over $1 million. That sounds intriguing, right? Well, it might be a little bit misleading because there's more to it than that. And let's explore why that is. This is Mark Perspectives, and today we're looking at chasing returns and why that's a bad idea. I'm Cam Irvin, lifestyle financial planner and advisor, and this is brought to you by Irvin Wentborn. A common approach for how people pick an investment is to look at its history. The average person will look at an investment and see how it's performed over the last, say, 1, 3, 5, maybe 10 years. And depending on how they judge their criteria, they'll choose one or several of those time periods to evaluate it. Even a huge number of financial advisors take this really simplistic and flawed approach for investment analysis. Then, what they'll do is map those returns onto the future. So if a stock returned 50% over the last couple of years, someone will usually assume that makes it a good investment and it'll keep going. People make the same assumptions not with individual investments, but even indexes, sectors, asset classes, all kinds of things. It's common for people to believe that history will repeat itself, and that informs their view of the future. We talk a little bit about this in our other video, The Best Performer, which you can access here. The problem is, what's happened in the past does not necessarily mean that's what's going to happen in the future. For example, the world record for the fastest marathon in 1920 at the Olympics was 2 hours, 32 minutes, and 35.8 seconds, set by Hans Kolomainen at the 1920 Summer Olympics held in Antwerp, Belgium. If you ran a marathon today at 2 hours and 32 minutes, you wouldn't even be competing in the Olympics. So what worked before doesn't necessarily work anymore or in the future. But let's look at some real-world examples of different investments and see how that's worked out for the typical investor. Cathie Wood is a big-name portfolio manager of the ARK Innovation ETF, and that fund has returned 23.5% annually since its original launch in 2014, compared to the S&P 500's 14.6% annualized return over the same period through 2021. Between early 2019 and February 18th of 2021, ARK returned a whopping 203% compared to a still respectable, but much smaller, 24% return for the S&P 500. But then, from the 18th of February 2021 through the 7th of January 2022, so about 11 months, ARK lost 43%, while the S&P still gained another 21%. Here's where it gets interesting. Even though ARK had gained quite a lot of value, especially since its beginning, most investors found out about the fund because it had such amazing performance, and that's when they decided to invest. Then it lost a bunch of value. So there's a small number of investors that won it big, but most of the investors that were actually in the ARK ETF ended up losing value on what they put in. And not just losing a little bit, losing a lot. That's not unusual though. For example, Peter Lynch managed the Fidelity Magellan Fund from 1977 to 1990, generating about 29% average annualized return. Yet, according to a study by Fidelity Investments, the people that actually own the fund, the average investor in the Magellan Fund still managed to lose money over that period. How crazy is that? Ken Hebner's CGM Focus Fund gained 18% each year from the year 2000 to 2009, ranking as the top performing mutual fund tracked by Morningstar. But again, the average investor lost 11% per year just because of the timing. So if you can't just look at the history of an investment to determine what a good investment is, then what do? The answer is simple. There's a few things. Number one, invest in low-cost funds or ETFs that are broadly diversified all around the world. There are 47 different countries that are considered developed and emerging by index provider MSCI. You could invest in each of those 47 countries individually, or you could pick one or two funds that bundle them all up for you. That's what broad diversification means. You can make it easy on yourself. Number two, make sure you have at least a few funds in there, which might include various stock and share funds. If you're going to be making any withdrawals within the next 10 years, include some domestic as well as global bonds and some cash too. Quick note, if you wanted to include alternatives, you can, and this would include things like commodities, precious metals, real estate, derivatives, crypto, or other asset classes. But bear in mind, it's wise for those to probably be no more than something like 5 to 10% of your portfolio. And if they don't make up your portfolio at all, that's okay. You can still get enough diversification from the other asset classes, like shares, bonds, and cash. Number 3. If you're unsure how to set this up, seek help from a professional. Now, note, a professional does not include your friend, your brother-in-law, or your neighbor that made $1 million. A professional is someone that's gone through certification and qualifications so that they understand data and what actually makes a good investment. Number 4. You want to set a better expectation for yourself. So a starting point for a better expectation of what kind of returns you could expect from the stock market are more like about 7.5%, assuming that you are truly invested in shares, indexes, and funds that are diversified all the way around the world. If someone tells you that you should expect a 12% return, they probably haven't read serious research on what markets have historically offered. They might quote something like the S&P returning 10% on average per year. However, even though that is true, that's only one country. It's also true that the S&P has had many extended periods that have gone on for 20 or 30 years, with returns as low as something like 2% to 4% on average each year. You can check that data for yourself, even look at it here in the Credit Suisse Global Investment Returns Yearbook that gets published each and every year about the returns from different countries. So the point of all this is really to say that chasing returns is a fool's errand. It's a lot like buying yesterday's lottery tickets. If you enjoyed this video, reach out. You can always find us at our home on the web at irvinwenborn.co.nz, email, LinkedIn, Facebook, or other socials. And if there's someone else that you think would enjoy or disagree with this video, share it with them. Find out.